Welcome to this explainer. Today, we're diving deep into the visual language of the market to see exactly how high leverage positions completely dictate price action. If you've ever wondered why the market suddenly violently sweeps in one direction seemingly out of nowhere, well, you're in the right place. We're going to decode the underlying architecture of these massive price movements. But before we map out the timeline of a real market event, we really have to ask ourselves, what actually happens when traders get backed into a financial corner? Imagine billions of dollars resting on a tightrope. When the wind blows just a little too hard, what happens to all that capital? It doesn't just disappear. It literally becomes fuel. See those glowing electric yellow bands resting horizontally across the screen? That's not just pretty data. Those are billions of dollars in highly leveraged positions just waiting to be triggered. They act as these massive, irresistible magnets for the asset's price, pulling it closer and closer until, bam, the trap snaps shut. So here's our roadmap for this explainer. We'll start by decoding the heat map, then look at how the leverage setup builds, move into the liquidity squeeze, witness the cascade event, and finally, survey the aftermath.
All right, let's jump right into Section 1, decoding the heat map and reading this visual data.
To read this map, we really need to understand the terrain. The core concept here is liquidation leverage. Simply put, this is the estimated volume of highly leveraged positions that will be forcibly closed by the exchange if the asset's price hits that specific level. Understanding this single concept, that's your key to predicting market sweeps. It's the invisible force driving the chart, because when an exchange forces a closure, it executes a market order. If enough of these sit at the exact same price, you get a chain reaction. Let's look at our baseline layout here on July 1st. Notice how the jagged line of price action moves through this sea of horizontal bars. These bars stretch right across the screen, representing resting liquidation levels. Honestly, think of the price as a pinball, and these horizontal bars are the bumpers and flippers just waiting to be struck. So the crucial trick here is contrasting the colors to understand exactly where the danger lies. The deep matte black and purple zones, those are your safe areas, low leverage, low risk. But those glowing electric yellow bands, that represents massive, concentrated, extreme danger. The brighter the yellow, the thicker the band, the stronger the magnetic pull for impending volatility.
Which brings us to Section 2, the setup, and watching how this leverage builds.
We're going to track a real 6-day trap. We'll start at that baseline, watch the leverage aggressively accumulate day by day, and finally witness the inevitable drop. Just look at how the landscape fundamentally changes in a single day. From the morning to the evening of July 2nd, the yellow bands around 60K to 61K thicken drastically. They start glowing brighter and wider as overly confident traders pile on extremely dangerous leverage. They are effectively building their own trap. And as we roll into July 3rd, the aggregate scale on the y-axis balloons to a staggering $111.15 million. To put that in perspective, that's enough cash to buy a whole fleet of private jets, all resting on just a few ticks of market movement. This isn't just a minor cluster of bad bets. This is a systemic buildup of extreme liquidity. And this view perfectly captures the sheer gravity of that number. Look at that intense, unbroken yellow wall forming right below the price action on July 3rd. The heat map is practically screaming at us that there is an absolute fortune resting right below the current price, just begging to be taken. Now, for Section 3, the squeeze, where the market goes hunting for that liquidity. Let's break down the mechanics of what's about to happen here. Step 1, the price probes downward and barely touches that high leverage yellow line. Step 2, the exchange steps in, and those over-leveraged traders are forcibly liquidated. Step 3, because those liquidations are forced market sell orders, it instantly drives the price down even further, right into the next glowing line. It's a complete domino effect. Check this out. Throughout July 3rd, the price gets completely boxed in. We have glowing violet and yellow walls forming both above and below the price. It's trapped. The market is acting like a financial pressure cooker. Traders are aggressively leveraging up in both directions, totally ignorant of the fact that they're just providing fuel for the inevitable breakout. So, the tension is palpable, which leads us to Section 4, the cascade event and the inevitable release. As the clock strikes midnight on July 4th, these leverage walls are intensely thick. You could almost feel the silence in the market preceding the storm. That electric yellow line is drawn brightly across the chart. Literally everyone is watching, waiting to see which side of this pressure cooker is going to blow first. The tell arrives in the early hours of July 6th. With upward momentum exhausted near the 64K mark, the market turns its heavy gaze downward, right toward those bright, glowing yellow magnets resting patiently below. And boom, there is the violent release. The price absolutely plummets. It doesn't just tap the levels, it slices straight through those glowing yellow walls at 62K and 61K like a hot knife through butter. As soon as the price hits that first band, the forced liquidations fire off rapidly, creating a massive cascade of automated selling that instantly devours all that trapped leverage. Which brings us to our final section, the aftermath, and a completely transformed landscape. By the late hours of July 6th, look at this, the landscape is completely unrecognizable. Those massive electric yellow bands, just gone, completely consumed by the price crash. The market wanted that liquidity, it hunted it down, and it absorbed it entirely. The board is wiped clean. So what should you really take away from this explainer? First, high leverage inherently acts as a magnetic target, period. Second, reading these glowing pools gives you a structural map of impending volatility, well before the price actually makes a move. And finally, massive leverage clusters never, ever resolve quietly. They inevitably release through violent, sweeping price action. The data is the hero here, guys. It tells the story before the final chapter is even written. After seeing how these magnetic forces systematically build, trap, and devour capital, you really have to look at the chart differently. The next time you're thinking about placing a highly leveraged trade right above one of those glowing yellow bands, you have to ask yourself, are you trading the market, or is the market's liquidity trading you? Thanks for joining me on this explainer, and I'll see you in the next one.